You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive. Today we're cracking open a really interesting set of sources covering global markets, policy moves, and some key geopolitical flashpoints. Our mission, like always, is to give you that shortcut to being well-informed, pulling out the key insights you need for the week ahead.
And it's definitely a crucial week. You know, we've got thin liquidity because of holidays in the U.S. and Canada, but the big policy news and the geopolitical shifts, they haven't stopped.
Right, so thin markets mean bigger potential moves on news.
Exactly. Every piece of news gets amplified. So what we're trying to do here is help you navigate this divergence we're seeing. There's this gap between, say, soft political talk and some pretty hard market actions.
And between efforts towards peace, but ongoing conflict elsewhere.
Precisely. We need to sift through that noise and really isolate the signal. That's the goal.
Okay, and we've got quite a range of signals to look at. We're covering everything from FX and commodities, trade policy like tariffs and industrial strategy, right through to major geopolitical hotspots like Middle East peace process, Ukraine.
Yeah, and even regional clashes. So let's jump right in. Maybe start with the markets. The dollar, commodities, and some of that underlying financial infrastructure news.
Okay, the dollar first. It looks like it's rebuilding some momentum after dipping late last week.
That's right. It's getting a lift, partly because the euro's looking a bit soft, and there's also a general move away from typical haven assets. The U.S. dollar index is firmer overall.
But the yen is still looking weak.
Very much so. It's under serious pressure in this thin holiday trading. And you know, even though Japan's finance ministry keeps saying they're watching for disorderly moves,
the market isn't really buying it yet.
Not really. The talk is there, but the pressure remains.
Yeah.
And then on the euro side, you had the ECB's Vujčić basically signaling they're comfortable with how things are now.
Which means no imminent tightening from the ECB.
Exactly. No suggestion they need to tighten to fight inflation or boost the economy right now. So that kind of removes any reason for the euro to rally strongly.
And if the euro can't rally, the dollar looks better by comparison. Makes sense. What about sterling? You mentioned it's softer.
Yeah, a bit softer. There's still some chatter and uncertainty around the upcoming UK budget, which is weighing on it slightly.
Okay. But interestingly, the Aussie and Kiwi dollars are actually leading a bit of a recovery.
They are. And that tells you something about risk appetite, you know. It suggests maybe risk sentiment is firming up a bit.
Which connects to commodities.
Directly. Look at crude oil, it's ticking higher. Some of the initial panic about recent trade talks seems to have faded.
And the U.S. downplaying immediate conflict escalation probably helps too.
Definitely. So the market's focus kind of shifts back towards the fundamentals. People are now waiting for OPEC's monthly oil market report to get a better sense of supply and demand balance.
You mentioned something really specific, though, about physical demand signals, something that shows real buying interest.
Ah, yes. This is where it gets quite granular, but it's telling. Iraq's state oil marketer, Hessomo, they just adjusted their November prices for Basra medium crude. They nudged prices up slightly for buyers in Asia, but actually offered discounts compared to Brent for European buyers.
So they're fine-tuning prices based on where the demand is strongest right now.
Exactly. It's not random. It's the physical market optimizing flows, pulling pricing levers. That kind of targeted adjustment suggests real underlying demand health, not just paper trading.
Wow. Okay. That's a fascinating detail. So the supply side is being quite strategic. What about metals? Gold hit records.
It did. Spot gold pushed to new highs in Asia earlier before pulling back a bit. But the action in silver is maybe even more interesting right now.
Why is that?
Well, silver's had this sharp rally, and sources are pointing specifically to shrinking stockpiles of readily available physical silver in London.
So actual physical tightness, not just futures market stuff.
Right. That points to a real supply constraint, which can fuel volatility and strong upward pressure, at least in the short term.
Got it. And copper. Dr. Copper, as they call it. It's bouncing.
It is. You know, traders are weighing things up. On one hand, you have the potential hit to demand from all the tariff talk.
But on the other hand...
On the other, you had those surprisingly resilient Chinese trade numbers recently. Copper is often seen as that bellwether for global growth.
And the fact that it's bouncing suggests maybe the fears about a demand collapse are a bit overdone.
Perhaps. It's definitely holding firm, which is noteworthy given the headlines.
Okay, this takes us neatly into the policy plumbing side. There were a couple of really unusual, almost technical developments that could impact the dollar. First, the CPI data.
Yes, the Bureau of Labor Statistics. They're apparently preparing to publish the September Consumer Price Index, even with the federal shutdown ongoing.
Why is that still happening, and why is it so important right now?
Well, it's crucial because that CPI number is probably the single biggest piece of data the Fed looks at for its next interest rate decision, and that decision drives the dollar.
So they're protecting the release mechanism because the market absolutely needs that number.
Precisely. It's seen as essential market information. It really can't be delayed, if at all possible.
And the other piece of plumbing news, something about FedWire.
Yeah, the Fed reiterated this major, though kind of quiet, shift they're making. They confirmed their big real-time payment systems. FedWire funds and the National Settlement Service are adding Sunday and holiday operations.
So moving towards 24/7 operation.
Essentially, yes. 24/7, 365. These are the core pipelines for high-value payments between U.S. financial institutions. Traditionally, they shut down outside business hours, weekends, holidays.
And the shift means?
It means the U.S. is basically acknowledging that global commerce doesn't stop for U.S. holidays or weekends anymore. It reduces friction, speeds things up. But, it also raises some deep questions about market stability, especially on days that used to be predictably quiet.
Okay, shifting from financial plumbing to trade policy, there seems to be a real disconnect in the U.S. rhetoric on China right now.
Yeah, it's quite striking. Over the weekend, the U.S. president sounded very conciliatory, saying Washington wants to help China not hurt it.
But, and this seems like a big but, the threat of putting 100% tariffs on all Chinese goods wasn't actually taken off the table, was it?
No, explicitly not withdrawn. So you have this soft tone, but this massive threat is still hanging there. What do you make of that? Is it genuine de-escalation, or is it more like strategic ambiguity, keeping Beijing guessing?
Hard to tell. How's Beijing reacting?
Well, they seem to be treating it as leverage, perhaps. They've been very quick to frame their own recent actions as just defensive measures.
Like the rare earth export controls from October 9th?
Exactly. They defended those, saying it's just legitimate oversight of dual-use tech stuff with both civilian and military applications. They stressed it's not a blanket ban, and companies can apply for licenses.
And then there were new port fees on U.S.-related ships.
Right. Again, framed as a direct defensive response to earlier U.S. moves on shipping charges. It feels very tit for tat. Both sides are trying hard to control the narrative.
Washington says we want to help, but the policies keep the pressure on.
Which forces Beijing to respond, calibrating their own moves. And it tells you how high stakes this is, that the U.S. Trade Representative's office reportedly sought a call right after those rare earths controls were announced. There's clearly a lot going on behind the scenes.
What's fascinating, too, is how other countries are reacting, almost hedging against this U.S.-China instability.
Oh, absolutely. Look at Canada. They're drafting a new industrial strategy. And it explicitly talks about shifting towards more domestic procurement and finding new markets because of the U.S. tariff situation.
Reducing their reliance on the U.S. market.
Minimizing their vulnerability, yeah. And you see similar moves elsewhere. Switzerland and China just agreed to speed up talks on upgrading their existing free trade agreement.
Shoring up stable relationships.
Exactly. And at the same time, you have an Indian delegation heading to the U.S. trying to finalize an early harvest trade package, signaling they might buy more U.S. energy. Everyone's kind of rewiring their trade links to navigate this new landscape.
Now, another major policy flashpoint that popped up this UN proposal related to carbon. Washington came out swinging against what they termed the UN's first global carbon tax.
So the context here is a proposed international mechanism, maybe funded through levies on things like international shipping or aviation, to help pay for climate adaptation and mitigation efforts globally.
And the U.S. response was immediate opposition.
Very strong opposition. Washington said it will act to, quote, defend Americans from this perceived tax.
And the potential actions they floated are pretty serious probes, visa limits, port fees, even targeted sanctions against governments that support the mechanism.
Yeah, it's a comprehensive threat. It really signals deep political resistance, at least from this administration, to any kind of global levy system for climate finance.
Okay. And shifting gears slightly, but still related to global flows, the tech sector.
Yeah.
Seems like scrutiny on the chip supply chain is really ramping up globally.
It really is. You've got action on multiple fronts. In China, the antitrust authorities are looking into Qualcomm's deal to buy Autotalks, suspecting rule violations.
Okay. And in Europe.
In the Netherlands, the government is moving to tighten its oversight of Nexperia. That's a chip maker owned by a Chinese company. And they cited governance concerns.
So it's about national security concerns around critical infrastructure.
That seems to be the core issue, yes.
Mm-hmm.
Chips are now viewed as vital national security assets. Every major player is trying to ensure control and security within their own sphere.
And it's not just about ownership and deals, right? There's enforcement, too.
Absolutely. The US FCC chair mentioned that e-commerce platforms have apparently been removing millions of prohibited Chinese electronic devices from sale. So the tech barriers aren't just being discussed, they're being actively enforced, even down to the consumer level.
All right, let's turn now to what might be the biggest geopolitical story unfolding today, the situation in the Middle East. There's a major summit happening in Cairo.
Yes, an international summit hosted by Egypt. Leaders from the US, UK, France, the EU, they're all expected there to try and formalize this Gaza de-escalation plan.
And the details that have emerged about this plan seem quite significant.
They really are. Reports indicate Israeli officials have approved the basic framework. A hostage release is apparently slated for today, Monday.
And Hamas has commented.
Yes, Hamas announced the agreement includes Israeli withdrawal from certain areas and a prisoner exchange component. Washington has even stated that under this plan, the war is over and Hamas will disarm.
Wow, that sounds incredibly decisive. Almost too good to be true, given the history.
That's the immediate question, isn't it? Sounds like a breakthrough. The U.S. president reportedly intends to attend a signing ceremony in Egypt. But you have to weigh this against the underlying regional dynamics.
Like Iran's reaction.
Exactly. Iran's foreign minister came out almost immediately, dismissed any idea of Iran joining the Abraham Accords, and flatly ruled out recognizing Israel.
So the fundamental disagreements are still completely unresolved.
Utterly. This framework might, if it holds, stabilize the immediate Gaza conflict, but it doesn't magically fix the deep-seated regional power struggles or ideological divides.
Although, it's interesting, even as Iran publicly rejected normalization, they also apparently signaled that back-channel talks with Washington are still happening.
Right. That's the complexity. You have this public hardline stance, but simultaneously these private communication lines remain open, likely to manage immediate risks and avoid unintended escalation. Two parallel tracks.
A very tangled web. Meanwhile, the conflict in Ukraine, it's still very much active.
Absolutely. Very hot. We've seen continued strikes hitting power and energy infrastructure across Ukraine. Kiev reported hitting a refinery deep inside Russia in Ufa.
And Russia's response?
Moscow claimed it shot down dozens of Ukrainian drones. The focus very much remains on hitting critical economic and energy targets on both sides.
And there was also a significant warning, potentially aimed at pushing towards a settlement.
Yes, from the U.S. side. The president suggested he might warn Russia that Tomahawk missiles, long-range cruise missiles, could be supplied to Ukraine if a settlement isn't reached soon.
That's a major potential escalation, a serious threat.
It is. It's designed to significantly change Moscow's calculations about the long-term costs of the war.
And how is Kiev navigating this?
Carefully, it seems. President Zelensky discussed air defense needs with Washington, but also gave assurances that any long-range systems they might get would only be used against military targets, trying to secure the aid while managing allies' concerns about escalation.
So connecting this back globally, these friction points seem to be everywhere now.
They really are multiplying. You had deadly clashes on the Pakistan-Afghanistan border requiring mediation.
Yeah.
You had the Philippines and China trading accusations after another collision near Sandy Cay in the South China Sea.
North Korea.
Actively signaling deeper coordination with Russia, while also pledging to strengthen ties with Beijing. It really paints a picture of increasing geopolitical fragmentation defined by these regional flare-ups, proxy conflicts, but also this backdrop of very careful, often parallel diplomacy. It's the dominant theme right now. #tag outro. So as you process all of this heading into the week, remember, thin trading, but lots of potentially market-moving news. We think there may be 3 key indicators to watch for the clear signals.
Okay, what should people keep an eye on?
First, just watch the dollar's reaction as that plan to publish the US CPI firms up. That data point is likely to anchor Fed expectations regardless of the holiday liquidity.
Right, the data trumps the thin market context.
Second, keep a close eye on copper and crude oil. They probably offer the cleanest real-time read on whether the global growth outlook is holding up against all these trade risks and geopolitical shocks.
Growth versus risk repricing. Got it. And third?
Third, watch the news out of that Cairo summit today. Look for tangible confirmation that the Gaza de-escalation plan is actually proceeding as outlined, especially those specific hostage releases planned for today. That would be a key sign.
It really is a week of profound contrasts, isn't it? We're talking about formalizing a major Middle East peace framework while simultaneously seeing what looks like industrial warfare and tech crackdowns across the Pacific, plus the ongoing war in Europe, trying to build stability in one area while actively destabilizing relationships elsewhere.
It's a striking paradox. And, that leads us to our final thought for you, the listener, to maybe mull over.
Go on.
If the core plumbing of the global financial system, things like Fedwire in the U.S., are moving to operate 24/7, including holidays, what does that actually tell us about the nature of liquidity or even stability in today's world? What does it mean for market vulnerability when huge geopolitical events, peace summits, trade wars can all now happen and be priced in real time, even on days that used to be completely quiet? This constant connectivity, it fundamentally changes how we should think about risk, doesn't it?
That's a really potent question to end on. Something definitely to think about as we navigate the week ahead.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.